Before the market even opens, before the first trade, before the headlines are written, something goes silent. Not a crash, not a halt. Not an error message most people would notice. The reporting stops, the numbers freeze, and the most important financial exchange in the world suddenly stops telling the market who owns what, slightly slower. This doesn't happen during chaos. It happens when the system is trying to buy time. Because when prices move, markets panic, but when data disappears, institutions do. And what happens next, at the opening bell, will quietly decide who gets paid and who only thought they owned something. The question is not what failed, it's why it failed now. In modern markets, most damage does not arrive with noise. It arrives quietly through absence. On the surface, everything appears normal. Prices are still visible, charts still move, futures still trade electronically. But underneath that activity sits a system far more important than price itself, reporting. Reporting is not commentary, it is not media. It is the official record of ownership, delivery, and obligation. It is the ledger that tells the financial system who owes what to whom. When that ledger stops updating even briefly, markets are no longer operating on facts. They are operating on assumptions. The CME is not simply another exchange. It functions as a central nervous system for futures markets, including metals, rates, and commodities that banks use as collateral. Its reports are not optional disclosures. They are the backbone of settlement, margining, and risk models across the global banking system. This is why a reporting blackout matters more than a price swing. Volatility is expected. Markets are designed to absorb losses. And what markets struggle to survive is uncertainty about ownership. If participants cannot verify delivery data, position reconciliation, or settlement flows, confidence erodes at the institutional level first, long before retail investors notice anything unusual. This is the anomaly that matters. When reporting goes dark, it does not mean trades stop. It means verification stops. Clearing systems continue to process transactions, but the transparency layer, the one that allows participants to confirm that the system is balanced, becomes incomplete. That distinction is critical. A market can function temporarily without stability. It cannot function without trust in the ledger. Timing makes this more significant. Reporting disruptions during active trading hours are rare and immediately visible. When disruptions occur during low liquidity windows, weekends, batch processing periods, or pre-open settlement cycles, they are harder to detect and easier to contain quietly. These windows are when clearinghouses reconcile positions, validate delivery notices, and prepare the official record that underpins the next trading session. If something fails during this window, the market does not see it immediately. Institutions do. Banks, dealers, and clearing members do not wait for headlines. They monitor operational signals, delayed updates, incomplete fields, reports that fail to refresh on schedule. These are not cosmetic issues. They feed directly into internal risk systems that decide whether capital is deployed or withdrawn. When those signals change, behavior changes. This is why silence can be more disruptive than volatility. A price move can be hedged. Missing information cannot. When a system stops confirming its own state, every participant must assume higher risk by default. The rational response is caution. This is not speculation. It is standard risk management. Modern financial systems rely on continuous reconciliation. Every contract represents a promise that must be matched by collateral, inventory, or offsetting exposure. Reporting is how the system proves those matches exist. Without it, even solvent positions appear uncertain. Historically, moments of reporting stress have preceded major structural shifts, not because reporting caused the shift, but because reporting revealed pressure already present. In those moments, institutions act defensively. They reduce exposure. They widen margins. They slow activity. Not out of fear, but out of responsibility to balance sheets. This is where the misunderstanding often begins. Public narratives focus on price because price is visible. Institutional narratives focus on plumbing because plumbing determines survival. When the plumbing shows strain, price becomes secondary. What matters is whether obligations can be met without dispute. At this stage, nothing has collapsed. No default has occurred. No official announcement needs to be made. But a line has been crossed quietly. The market is operating with incomplete confirmation. That alone is enough to change behavior. The most important point is this: markets do not wait for certainty. They react to risk. And missing data increases risk immediately, even if the cause is technical, temporary, or unresolved. This is why attention shifts away from traders and toward risk committees, away from speculation and toward exposure limits, away from optimism and toward preservation. The anomaly is not dramatic. It is procedural. That is precisely why it matters. When the ledger hesitates, liquidity does not disappear. It pauses. And when liquidity pauses, the next stage of the story begins, not in headlines, but in how capital chooses to move or not move when confidence and verification weakens. That is what must be understood before looking at prices, spreads, or market opens. Because once reporting falters, the The question facing institutions is no longer what is the price. It becomes something far more basic. Liquidity is often misunderstood. It is not cash, it is not volume, it is behavior. In functioning markets, liquidity appears abundant because participants trust that trades can be entered, exited, settled, and verified without friction. That trust is invisible when it works. It only becomes visible when it weakens. When reporting falters, liquidity does not vanish dramatically. It becomes selective. Institutions do not pull back because they are frightened. They pull back because their models demand clarity. Liquidity providers operate under strict risk parameters. Those parameters rely on timely confirmation of positions, margin obligations, and delivery eligibility. If the reporting layer becomes uncertain, models automatically increase assumed risk. When assumed risk rises, permitted exposure falls. This is how liquidity tightens quietly. The first signs are subtle. Bid-ask spreads widen by fractions that seem insignificant to most observers. Trade sizes shrink. Certain maturities trade less frequently. Dealers become less willing to warehouse risk. None of this makes headlines. But together, these changes alter the market's ability to absorb stress. There is an important distinction here between price liquidity and delivery liquidity. Price liquidity refers to how easily a contract can be traded. Delivery liquidity refers to how confidently a contract can be settled into the underlying asset. In normal conditions, these two move together. When reporting confidence weakens, they separate. Price liquidity can persist for a time because electronic trading continues. Delivery liquidity, however, depends on documentation, verification, and trust in the clearing process. If any part of that chain becomes opaque, delivery risk increases immediately. This matters most in markets where physical settlement is not theoretical, but real. Metals markets sit at the intersection of finance and inventory. Contracts represent claims that can, under certain conditions, convert into physical obligations. That conversion process relies entirely on accurate reporting. Without it, participants must assume the worst-case scenario when assessing risk. This is why arbitrage behavior changes first. Arbitrage is often described as risk-free. In reality, it is risk-managed. It only works when the path from purchase to settlement is predictable. If the reporting system that confirms that path becomes uncertain, the trade is no longer arbitrage. It becomes exposure. When exposure replaces certainty, algorithms adjust. Risk limits trigger. Human oversight steps in. Trades that once required no discretion suddenly require approval. Approval takes time. Time reduces liquidity. This is not theory. It is how modern markets are designed to protect themselves. Banks and dealers are especially sensitive to this shift because they operate with balance sheets constrained by regulation. Capital requirements, leverage ratios, and internal stress tests all assume accurate, continuous data. If data becomes unreliable, conservative assumptions replace optimistic ones. That change is immediate. What looks like a minor technical issue to the outside world can translate into a meaningful tightening of conditions inside institutions. A trade that was acceptable on Friday may not be acceptable on Monday, not because the asset changed, but because the system confirming it did. This is why liquidity events often precede visible price events. Liquidity responds to uncertainty faster than price because liquidity is managed while price is discovered. When fewer participants are willing to provide liquidity, the market becomes thinner. In thinner markets, price movements become more abrupt, even if the underlying information has not changed. This creates a feedback loop. Reduced liquidity increases sensitivity to orders. Increased sensitivity increases volatility. Volatility reinforces caution. Caution further reduces liquidity. None of this requires panic. It only requires uncertainty. Importantly, this process does not require any single actor to decide to withdraw. It emerges naturally from rules, incentives, and risk controls acting simultaneously across institutions. This is where timing becomes critical. If liquidity tightens ahead of a market open, the first trades of the session carry more weight than usual. They are not just transactions, they are signals. Other participants watch them closely, not for direction, but for confirmation that the system is functioning normally. If early trades struggle to clear smoothly, if spreads remain wide, if volume concentrates in narrow windows, confidence does not rebuild. It erodes further. At this stage, markets are not broken, they are cautious. But caution changes outcomes. The key insight is that liquidity stress does not announce itself loudly. It manifests as hesitation, as slower response times, as smaller commitments, as institutions choosing to observe rather than act. This is why focusing solely on price misses the point. Price reacts to liquidity, not the other way around. And when the informational foundation of liquidity weakens, the market enters a phase where outcomes are shaped less by opinion and more by structure. Understanding that distinction is essential, because the next layer of the story does not involve traders at all. It involves balance sheets, collateral, and the incentives that govern the institutions standing between markets and money. When markets appear unsettled, attention usually turns to traders. But traders do not decide how much risk the system can carry. Banks do. Banks sit between markets and money. They clear trades, extend credit, provide custody, and manage collateral. Their role is not to predict prices. Their role is to survive every price. That survival depends on balance sheets. A bank's balance sheet is a living structure. Assets on one side, liabilities on the other. Between them sits capital, carefully regulated and continuously tested. Every position a bank supports must fit within that structure, and every structure relies on accurate information. This is where reporting becomes decisive. Commodities, particularly gold and silver, play a unique role inside banking systems. They are not just traded assets, they are used as collateral. They support financing arrangements, they back obligations. Their valuation feeds directly into leverage calculations and risk-weighted assets. When reporting systems function normally, banks can model this exposure with precision. They know what exists, where it is, and under what conditions it can be delivered or pledged. When reporting confidence weakens, that clarity dissolves. Banks do not assume favorable outcomes in uncertain conditions. They assume conservative ones. That means higher haircuts on collateral, lower exposure limits, reduced willingness to intermediate. This is not a judgment, it is policy. Regulatory frameworks are built to enforce caution when uncertainty rises. Capital rules do not ask banks to be brave, they ask them to be solvent. If a reporting anomaly introduces even a small probability that collateral cannot be verified or settled on time, risk weights change. Those changes ripple outward. A trade that requires bank balance sheet support becomes more expensive. A position that relied on favorable margin treatment may no longer qualify. Financing costs rise quietly. Liquidity thins further. At this point, it is important to address a common misconception. Markets often attribute these shifts to intent, manipulation, coordination, or strategy. In reality, most of the behavior emerges from constraint. Banks respond to rules, incentives, and penalties. When information becomes unreliable, the safest option is always reduction. This is why banks prefer delayed transparency to incorrect transparency. Incorrect data is dangerous. It creates false confidence. Delayed data creates caution. From a balance sheet perspective, caution is manageable. False confidence is not. If reporting systems show inconsistencies, banks will slow activity until reconciliation occurs. They will wait for confirmation rather than assume resolution. This waiting period is not neutral. It reshapes market behavior. Balance sheets contract at the margin. Another layer matters here: debt. Modern financial systems are deeply leveraged. Debt amplifies returns, but it also amplifies risk when verification weakens. Debt relies on collateral values being trustworthy. If the instruments used as collateral are subject to settlement uncertainty, lenders respond quickly. Credit lines tighten. Terms adjust. Risk committees intervene. None of this requires public announcements. It happens through internal emails, revised thresholds, and automated systems flagging exceptions. These processes operate continuously, regardless of whether markets are calm or volatile. This is why banks are often accused of acting early. They are not predicting collapse, they are managing asymmetry. If conditions normalize, they can re-enter markets. If conditions worsen, early caution protects capital. From this perspective, reporting silence is not merely inconvenient, it is destabilizing. It interrupts the feedback loop that allows banks to calibrate exposure accurately. This has implications beyond a single market. Because banks are interconnected, one institution's caution becomes another's signal. When several major participants adjust behavior simultaneously, liquidity does not disappear evenly. It withdraws from the margins first. Those margins matter most. This is where pricing begins to decouple from assumptions. Not because prices are wrong, but because fewer balance sheets are willing to support them. At this stage, markets are still operating. Trades still clear. But the system is running with reduced redundancy, fewer shock absorbers, less tolerance for surprise. This is the environment into which a market open arrives. The opening bell does not resolve uncertainty. It exposes it. Banks do not wait for confirmation from prices. They watch settlement flows, margin calls, and early session behavior. If those signals suggest continued opacity, defensive positioning persists. This is why the next phase of the story is not about headlines or commentary. It is about how the first hours of trading reveal whether confidence is rebuilding or whether the system is adjusting to a new, more cautious equilibrium. And that adjustment, once underway, does not reverse quickly. It accelerates or stabilizes. The difference is decided not by opinion, but by structure. When markets reopen after a period of uncertainty, the first question is rarely about direction. It is about confirmation. The opening bell does not restore confidence on its own. It tests it. In the early minutes of a session, experienced participants are not focused on headlines or predictions. They watch mechanics, order depth, spread behavior, clearing efficiency, margin calls. These signals reveal whether the system is functioning normally or merely moving forward under strain. This distinction matters. There is a difference between volatility and repricing. Volatility reflects disagreement. Repricing reflects reassessment. One can occur without the other. In moments where reporting integrity has been questioned, markets lean toward repricing first. Repricing is not dramatic, it is methodical. Participants adjust exposure to reflect higher uncertainty. Liquidity providers demand greater compensation. Margins rise. Certain trades become uneconomic. Others are postponed entirely. None of this requires panic. It requires recalibration. The opening trades set the tone. If liquidity returns evenly, confidence begins to rebuild. Spreads narrow. Volume stabilizes. Risk limits relax incrementally. The system signals that verification, while delayed, remains credible. If liquidity returns unevenly, the message is different. Wide spreads that persist beyond the opening minutes suggest hesitation. Concentrated volume in narrow price ranges indicates caution. Delays in settlement-related processes reinforce the perception that uncertainty remains unresolved. At this point, markets are not malfunctioning. They are adapting. One of the most important tools in this adaptation is time. Institutions prefer time over action when information is incomplete. Time allows reconciliation. It allows audits. It allows alignment between records and reality. In some cases, exchanges and clearing entities will choose procedural adjustments rather than immediate resolution. These adjustments can take several forms. Settlement timelines may be extended. Margin requirements may be increased. Certain delivery options may be constrained. None of these actions signal failure. They signal prioritization of system stability over speed. However, these measures have consequences. Extended settlement increases the cost of holding positions. Higher margins reduce leverage. Constrained delivery changes the relative attractiveness of paper and physical exposure. Each adjustment nudges behavior in a more conservative direction. This is how markets reset without collapsing. The word reset is often misunderstood. It does not mean starting over, it means redefining acceptable risk. After periods of opacity, markets tend to operate with wider safety margins. That new baseline persists until confidence is fully restored. For businesses, investors, and institutions, the key is interpretation. A calm market open does not guarantee resolution. A volatile open does not guarantee instability. The true signal lies in persistence. Do conditions normalize quickly, or do protective measures remain in place? This is why the first hours matter more than the first minutes. If reporting clarity improves and liquidity follows, the episode becomes a footnote. If uncertainty lingers, behavior adjusts further. Credit tightens, exposure reduces, capital becomes selective. In that environment, assets tied closely to verification and delivery feel pressure first. Assets with fewer intermediaries feel it later. This is not about preference, it is about structure. Markets reward what can be confirmed. The most important takeaway is not tactical, it is strategic. Periods like this remind participants that modern markets are systems, not screens. Prices are outputs, not foundations. When foundations are questioned, even briefly, behavior shifts in predictable ways. Calm does not mean complacency. Urgency does not mean panic. The appropriate response is observation. Serious decision makers watch how rules are applied, not what commentators say. They track changes in terms, not changes in tone. They notice what becomes harder to do, not what becomes louder to discuss. In moments where reporting falters, the system reveals its priorities: preservation over expansion, verification over speed, stability over convenience. Those priorities shape outcomes long after the headlines fade. The story that began with silence does not end with noise. It ends with adjustment. An adjustment, once embedded, defines the next phase of the market more than any single event ever could. When information returns, confidence can rebuild. Until then, markets do what they have always done best. They protect themselves.